Hello and welcome to today's webinar, which is brought to you by Shared Services Link in association with TradeShift. Today we are looking at a really important e-invoicing compliance update, and we're going to be zeroing in on 4 countries. So great to have you with us today. Thanks so much for joining. My name is Susie West. I'm the founder and CEO at Shared Services Link. I'm hosting this webinar today, and our star for the day is Rolf Jensen, who is SVP Technology Platform from TradeShift. So great to have Rolf with us today. Make sure you get the most of your time with Rolf. He's going to be going into a lot of detail. There's a lot of material ahead of us. It's all need to know material. So get your pencils and pens and pads at the ready and your questions all set for Rolf for the last few minutes of this webinar. So let's have a bit of a moment to talk about context. We all know e-invoicing has been available for decades in the form of EDI, and then networks appeared around 25 years ago. Early adopters were using them 25 years ago. And I think most commentators and observers would say it was a fairly slow moving market in terms of adoption. It's surprising, isn't it, that there are still some mid-size enterprise companies that are still processing high volumes of paper invoices, manual invoices, often much higher proportions of manual invoices than electronic invoices. And why is this? Well, yes, there's been business cases there, but unfortunately sometimes these have been eclipsed by other priorities within the organization. But this kind of eclipsing can no longer happen, because now we have legal mandates coming in that are now compelling reasons for us to cross that chasm and move from manual to electronic invoicing. So we're now seeing CTC clearance models mandates coming in to play, and this is expediting real change in what some may argue has been a slow adoption market. So no more excuses, no more procrastination. We're seeing now laws and requirements, they're forcing that change. Yes, very much on the sender side historically, and now very much on the buyer side. So we are now being forced to trade electronically. But business cases existed in the past. Guess what? They're only going to continue in the future. So this is not just about complying with legal mandates. It is about leveraging those business cases and really getting your heads around what those business cases are, and driving through the change and seeing, yes, the compliance, but yes, the fruits for those financial benefits as well. So e-invoicing is going to be de facto, and there's no getting away from it. There is no escape route. This is the only way forward. Today, we're going to be looking at 4 countries: Romania, France, Malaysia, and Poland in detail. And I'm delighted to say that Rolf has a bonus country for us as well. So he's going to reveal what that bonus country is in the next few minutes. So over to you, please, Rolf.
Thank you, Susie. Super happy to be here today, and very excited to talk about this topic that we are spending quite a lot of time on inside of TradeShift, in order to make sure that all of our customers, buyers, and sellers can keep on doing their business everywhere in the world. If we look at today's agenda, we will start by just taking a high-level overview on what is it that is happening, what is continuous transaction controls, or clearance as we refer to it, and then take a deeper dive looking a little bit more at VIDA, which is a initiative in the EU, and where there was actually a development as late breaking as yesterday, where the ratification actually was vetoed. Drama by one of the member states, but we'll get into that, and what does it mean, and especially what does VIDA mean for accounts payable processing and e-invoicing compliance. Then in the second section, we'll take a deep dive, as we talked about. As Susie talked about, we'll dive into Romania, France, Malaysia, Poland, and the last one will be Germany, which has also in the past month or so announced that e-invoicing will become mandatory. Receiving e-invoices will be mandatory for all businesses as soon as January 2025, so actually coming up in a short 6.5 months or so. Finally, I'm very excited to talk to you all about Tradeshift's approach to compliance and what we actually believe is one of the most important things to consider, especially on the accounts payable side as we approach clearance regimes across the world. With that, why is this a relevant topic to approach exactly today? As we will see shortly, the world is changing, and the world is changing fast, and is doing so now. Many countries have plans and timelines for mandates and rollouts. There are very frequent updates to all these timetables. Every country faces what essentially is an overhaul of all of the trade that happens within their jurisdiction, how it is accounted for, and how what companies have to do to live up to it. So these are huge, complex processes and projects, and we've seen that already for countries such as France, such as Poland, and others, that timelines that have been announced actually change. It is also extremely important to talk about, and this is a little bit of a teaser to the third section here, is that clearance, and as Susie mentioned, the transition to mandated e-invoicing is a huge opportunity to accelerate digitization projects that you might have had in your companies, and if it's done right, also an acceleration towards a much larger portion of your invoice volume being processed as straight-through processing. So great efficiency improvements. On the other hand, if it's just implemented blindly, we believe that you may suffer from your efficiency basically going down or completely being actually ruined by this large influx of invoices coming in digitally. But more about that later. First, we will kick into gear and talk a little bit about what is clearance overall. Before we dive into it, a poll question.
That's great. Thanks so much, Rolf. So what is your situation today? Please select one that applies. You have a solution already for your e-invoice compliance. Maybe you're looking for one, evaluating one right now, or thinking about evaluating. Maybe you're not seeing this as a problem right now, or maybe you just don't really know what you need, so you haven't quite made that step forward into active evaluation. So we're at about 40% of you responding. If you could let us know what is your situation today, and we'll be closing the poll in 3, 2, 1. Okay, thank you very much. We're at 60% of you responding, so let's have a look at the results. So a quarter of you have a solution for e-invoice compliance today. Just under half, so 43% of you are looking for a solution. 11% of you are not looking today, and 20% of you are not entirely sure what you need. So thank you for sharing that with us. Back to you, please, Rolf.
Absolutely. Well, we certainly hope that we can help inform some of you and give you some new perspectives. Talking about compliance generally, though, the countries in the world fall into two camps, generally speaking, today. One is the post-audit, which is the traditional model, meaning that companies on a regular cadence file basically their taxes on their tax reports on their transactions, VAT or sales tax or whatever else is applicable. The other camp is the clearance camp, which is what the world is transitioning to at large, and that is essentially that all companies register all their transactions in real time or close to real time in order for tax authorities to claim taxes accurately and in a timely fashion. Talking about the post-audit model, e-invoicing certainly has been possible and is being conducted and also at scale, although we, as Susie said, see lots of paper traffic still. Traditionally, e-invoicing in a post-audit world comes with a number of different requirements listed here: authenticity, content integrity, legibility, archiving, and tax compliance. And solution providers such as ourselves make sure that there is compliance to these requirements in each country. On the clearance side, or continuous transaction controls, as it is also referred to, basically the tax authorities require that all transactions are reported either completely real time, so each and every transaction passes through a governmental tax system and gets cleared, or that there is a real-time or near real-time reporting of all transactions. There are variations over the theme, but generally the government's authorities will provide systems, IT systems to integrate to standards for formats and protocols for exchange and requirements on timeliness on registering all transactions, and in some cases even disintermediate the seller and the buyer. So what's happening across the world? Well, as I said before, the world is changing, it's changing fast. And certainly we expect that most of the world will, over the course of the next, say, 6, 7, 8 years, move towards CTC-based legislation and systems. So it is a change that's happening, and it's happening fast. If we look more specifically at the EU and VIDA, so why this initiative and why talk about clearance systems? Really, it's about closing the VAT gap. And so looking at what is the VAT gap in the EU, in 2021, the VAT gap was 61 billion euros. And so basically, this is revenues that are lost to the tax authorities due to misreporting, fraud, bankruptcies, malicious or non-intentional errors made by businesses in B2B and B2C and so forth, B2G. This is a huge revenue gap, and one that the tax authorities are looking to close as quickly and as efficiently as possible. In the EU, the VIDA or the VAT in the digital age initiative is one that has been underway for quite a while. It has been described, I think, starting 2021 maybe, and really is an attempt to address both the VAT gap, but also a number of other initiatives. The latest update on the timeline for VIDA came out yesterday, May 14th, where it was put on the vote to be ratified, but Estonia actually blocked the whole initiative based on concerns for the platform economy rules, which is one of the 3 main pillars. The other pillars of the EU VIDA initiative is digital reporting requirements, which is really what we are very keen on talking about here. Then it is platform economy rules, which seeks to address how especially online platforms, ride-hailing services, food delivery services, and others address VAT obligations are end businesses, consumers, business consumers, as well as providers and the platform themselves, who is required to pay VAT or to report the VAT and so on. So that's where the disagreement and where Estonia raised their concerns were. The third pillar is about basically implementing a single EU VAT registration to simplify the processes for all companies that do business across member state borders. If we look at the first pillar and consider how is this going to impact the businesses in the EU. So first of all, we are seeing that there is a huge difference in what member states are doing and when they are doing it. And so we see acceleration, of course, in some of the countries we're talking about today, Romania, France, Germany. We know Spain has changes that are coming. Denmark has recently introduced reporting requirements and so on. So there is an overarching framework from VIDA, but we will see differences in member states, which also means that for all companies, it's going to be extremely important to stay updated and stay relevant, and partner with service providers such as ourselves to guide the way through to compliance. We will see e-invoicing standardization, which means that we will see 1, 2, or 3 formats that all transactions are going to standardize on across the EU, and we see that already with both France and Germany. Then, although it's not, it's not 100% implied by VIDA, we do expect that over the course of several years, we will see establishment of actual continuous tracking controls frameworks in all countries. With that comes real-time reporting, and if there are not CCC systems, then definitely, like we see in Hungary today, there will be real-time reporting requirements. Finally, this will eventually mean that there's going to be much better fraud detection, and of course compliance with tax legislation, and companies generally will find themselves to be in compliance. Of course, participating is not an option. As we will see for the individual countries that we're talking about today, there are different mandate rollout timelines, and so for different sizes of companies and either receiving or sending invoices, there are different steps at which it becomes mandated. But ultimately, it will become mandated for almost all companies across the EU. With that, we'll start diving into each of the individual countries. When we look at a timeline, when we look at a timeline, it's also clear that over the past years and over the coming years, there are massive changes across the world, and this is, as I said before, a highly dynamic landscape with a lot of changes happening. And so, of course, it's not all clearance. A lot of it is also e-invoicing, or for instance, the introduction of the PEPL standard across many places in the world, where basically facilitating very standards-based integrations and exchange of business documents. Today, we'll focus on Romania and Malaysia, that are coming right now. Romania in July, Malaysia in August, the mandates kick into effect. France, where we have seen delays, but even so, pilots are beginning for some companies already by the turn of the year. And Germany, as I said before, just announced standards for e-invoicing. Finally, Poland, of course, I think about a month ago, announced significant delays, but even so, that's already now voluntary adoption of the KSEF system. With that, let's dive into this next section.
Okay, and we've got a poll question coming up now. So let's find out from you which countries are most important for your organization to consider for your e-invoicing compliance requirements. Please tick all that apply. Romania, France, Poland, Malaysia, or all of them and possibly others. So which countries in the below list are most important for your organization to consider for your e-invoicing compliance requirements? Romania, please tick all that apply. Romania, France, Poland, Malaysia, or all of them, plus maybe some others that we haven't had the opportunity to list here. Closing the poll in 3, 2, 1. Let's have a look at the results coming up. Great participation. Thank you so much. We were at 76% of you responding there. So we have a winner here at 55% is France. Followed in a strong second place, 38%, all of them, plus others, I should imagine. 36% of you saying Poland, 13% Malaysia, and 11% of you saying Romania. So any thoughts on that, please, Rolf, and back to you, please.
Thank you. Yes, I think interest in France, and France being a big market, is of course not surprising. Also not surprising, I think many companies do business across the world, and so the interest in many different countries it's also not surprising, but I think underscores the importance of staying up to date across the board. That being said, let's dive into Romania a little bit here. So Romania is moving overall from a post-audit to a CTC clearance model, which is a classic four-corner model, meaning that there is the tax authority in Romania called ANAF, and then there are Tradeshift and other service providers that then allow sellers and buyers to interact with the tax authorities, unless they do it directly, to both clear the invoices, but also to retrieve the invoices from the government system, what we call inbound clearance. And so the solution we are building will, for buyers, mean that there is an inbound clearance channel that retrieves all of the cleared invoices, and this is where basically the potential for, let's say, a swift switch to digitization becomes very much reality. We will also be developing and delivering outbound clearance for sellers, meaning that sellers will need to, of course, submit their invoices for clearance to tax authorities, and we will support that process. If we look at the timeline for the mandate rollout, we are looking at the actually January 2024 this year. There was an e-reporting mandate that commenced, and through to March 31st, there was a grace period, and then now July 1st, 2024, which is sort of really the big deadline everybody's tracking towards, is commencement of the enforcement. And so throughout the year, I think what we've seen is that the ANF systems for clearance have matured, and that there have been some ambiguities that have been cleared up, formats have been specified further, and so forth. And now July 1st, we're looking at sort of a full commencement of the enforcement, meaning there are penalties if you don't comply, and clear your invoices when you send them, and retrieve them from the government systems. From July 2024 onwards, we'll then see that it will become e-invoices will become the sole format that is required. If we take a look at what does this mean from a flow perspective, and this is where we'll also start talking a little bit about what the secret sauce, if you will, of the Tradeshift solution and method is. So essentially, sellers will submit invoices to government clearance, which is what you see in the top right-hand corner, and you will see variations over this flow for the other countries. The e-Factura clearance system will then clear the invoices. This is the government system. We can then pull the invoices on behalf of the buyer, and so you will be receiving all of your cleared invoices from the government system, and then they are now ready for you to process. We will then facilitate a process by which you can identify the supplier, and typically we see our customers on the buyer side have their suppliers mapped out, of course, in their ERP systems, accounting systems, and so on, and you'll need to have a little bit of information attached to them. Finally, and this is where we'll talk a lot more about this later, but there is a data gap, as we call it, and so clearance systems generally will mandate a certain degree of information in the invoices. That is enough for the tax authorities to determine taxes. However, tax authorities care less about whether the invoices have a PO number present or a cost center reference or a person reference present in the invoices, which typically is what we see customers use to enable efficient processing on the accounts payable side. And so we have a solution whereby we can loop the invoice back to the seller if the invoice does not meet these content requirements, what we call the business firewall. So that's a brief look at how this flow works. Looking at Malaysia, Malaysia is also transitioning from a post-audit to a CCC clearance model. But in Malaysia, I think we are seeing some additional interesting developments. In Romania, it's a matter of invoices, credit notes. There's a new document type called corrective invoices that we also see in Poland and in France, and debit notes and so on. But in Malaysia, there are a few more sort of interesting details. One is that the obligation is on the seller to actually transmit the invoice to the buyer, and they can do so by any channel they want to. So this could be email, this could be upload to a portal, however they want to. Malaysia is also provisioning a PEPAL infrastructure that allows for that exchange. But in addition to that, they're also doing inbound clearance, meaning that buyers can also connect, and we facilitate that to retrieve all of their cleared invoices if they choose to do so. If we look at the timeline here for the Malaysia clearance mandate, we are seeing that August 1st is where the mandatory e-invoicing commences, and so this is really the big date to look out for and to drive towards. So businesses with an annual turnover exceeding 100 million Malaysian ringgit will then be within the scope of the mandate by August 1st, 2024, and then there's a progressive rollout. The rollout period, of course, is fairly short, so it's just 1 year, right? So it's spaced out, but it's not that there's a lot of time to adopt this for everybody. If we look at the flow picture, that looks a little bit different for the Malaysia clearance. So the flow, because sellers also are allowed, and actually sellers have the obligation to ensure that the buyer receives the invoice. That is also facilitated in the solution that we have. Now, Malaysia, as I said, have a few special items that I think are worth knowing and understanding, and actually considering how they will impact your business processes. So Malaysia has a provision for what they call a cancellation period. So suppliers can cancel cleared invoices within the first 72 hours of issuance, which means that they're basically voided and they are now no longer liable for taxes. In effect, it's the same as issuing a full credit note for the invoice from the supplier, but there is no credit note and there is no credit note required, and so that processing needs to be handled, and it is one that we have support for in our solution to help you transition into this mode. Malaysia also has a notion of apologies, I lost my train of thought there. So Malaysia also has a notion of refund notes, and so refund notes are essentially credit notes, but after monies have been exchanged. And as we talk to our buyers, we find that this is not something that they natively have a facility for in their system, so we can help navigate that. At the same time, there is also a requirement for buyers to declare taxes on invoices they have received from international suppliers that are not registered with Malaysian tax authorities. So basically, a little bit confusing in my opinion, but the Malaysian authorities call this a self-billed invoice that has to be submitted for clearance by the buyer, a facility that we also, or process that we also facilitate. That brings us to maybe, according to the poll, the star of the show, France. And so, as we all know, maybe not all of us, but certainly we've been following very closely, the France mandate has been pushed out. So there were changes, and we were going to see activity already this year. However, that got pushed out. The French model is one where there are going to be a defined list of authorized partners, PDPs, that can be service providers under French finance law. Tradeshift is fully on track to become a PDP. We have an application, and our certification is under review, just like every other potential PDP out there. We are set to start pilots, and pilots are going to begin in January of 2025, so also in about half a year or so. The French finance law system is one of the more complicated ones in terms of the infrastructure, and also the different status messages, the changes to transactions, and the reporting requirements that are bestowed upon both buyers and suppliers in the system. If we look at the timeline for the French clearance mandate, it is also a phased approach. The pilot, as I said before, will start in January of 2025. September 1st, 2026 is sort of the timeline for a lot of big corporates to track, which is that there is a requirement for all large corporations. 300 large named companies will have to issue e-invoicing and have e-reporting obligations, but all companies have to be able to receive e-invoices. And so that means working with a PDP such as ourselves, or interacting directly with the PPF, the French government system. The mandate then progressively rolls out in a pattern that we've seen also from the other countries, in this case over a little bit of a longer timeline. Diving into some of the flows, and I'll not go into this a lot, but basically we see that there are, because of this four-corner model that is present in France, where there might be several, both there's a government system, the PPF, there's the different service providers, the PDPs, as well as delegated service providers that can be part of the picture. And depending on whether, from our perspective, on whether the buyer uses Tradeshift, the supplier uses Tradeshift, or maybe both the buyer and the supplier uses Tradeshift, we will see these different flows whereby the seller clears the invoice with the clearance system, and the buyer basically receives eventually the invoice. So we have some material here showcasing what the flows will look like in these different formats. And what I really want to communicate with this material as we see it is that there is a lot of complexity, but it is all something that we will handle, and for our clients this will all look, both buyers and suppliers, this will all look very seamless to their current process. With that, we move into Poland. Poland, we've been following quite closely, as they were originally planned to go live in July 2024. And we were definitely seeing that there were a lot of the format specifications that had both ambiguities and what to us looked like, let's say, specifications that would be complicated and complex to implement. We're hoping that we'll see some simplification over time here. But basically the whole initiative, the whole rollout was delayed quite significantly. So there's a staged rollout starting in February 2026. With that, we also expect that in the period until then, we will see some changes to the format and the protocol specifications and so on. If we look at the timeline for Poland, the new timeline is as such. We will see February 1st of 2026 that large taxpayers with an annual turnover exceeding 200 million zloty will be in scope for the mandate. And then already April 1st, so 2 months after, then all other taxpayers will be required to use KSEF for B2B invoicing. What we saw with the previous plan was a much more elaborate and complicated rollout. And one of the things that were communicated from the Polish authorities when they announced the delay to the plans was that the stage rollout simply also became too complicated in terms of who's in, who's out, how do we deal with if you're in, if you're out, if you're transitioning, and so forth. Looking at the flow for Poland, it is going to be quite similar to what we see in Romania, and for that matter also how it eventually will work for France. The seller submits invoices to government clearance. We pull invoices from the clearance system, and then we go through the rest of this process whereby we allow the seller to enrich invoice with information that otherwise might be necessary for the buyer to do efficient processing of the invoice. With that, turning the attention to the bonus country, not originally announced with the webinar, that is Germany. Germany has announced e-invoicing. And so now we are not talking clearance, we're not talking continuous transaction controls, but really just e-invoicing. And what this means is that Germany has announced a standard format, Ex-Rechnung, EN 16931, as a standardized format, and that there will be a timeline that basically dictates that all companies already January 2025 will have to be able to receive electronic invoices in this format. There is no specification of protocol, so this can be by email, or this can be this could be an integration interface, upload to a portal, however it must be, but the format has been standardized. We also fully expect that at some point Germany will also turn towards a clearance model, and this lays the ground and lays the ground for that transition for all German companies. Again, looking at the timeline, January 2025, so very soon, all companies must be able to receive e-invoices. Then there's a milestone the following year, 2 years out, sorry, from that, so January 2027, where e-invoicing becomes mandatory. So I think in a very German fashion, this is all very orderly and planned out, and then January 2028, the mandate applies to all companies that they must issue e-invoices and be able to receive them, of course. If we look at the flow for this, the very low barrier for adoption solution that we will have for this, we will support, of course, the Ex-Rechnung format in any of our integrations. Supply can upload it on the accounts on Tradeshift and so forth. We will also be providing just an email inbox for buyers, and so you can communicate one address to your suppliers, and they can send an email with the invoice attached, being sort of the lowest common denominator, lowest possible barrier to adoption, but also one that promises swift digitization. With that, I would actually like to spend just a little bit of time talking about what is Tradeshift's take on compliance, and particularly clearance. I've talked a little bit about this today. The introduction of all of these e-invoicing regimes or clearance regimes are sort of a double-edged sword, because on the one hand, it means all your information will be coming at you digitally. All your invoices are available in a standardized format. This is great news, and one of the things that have hampered adoption of e-invoicing always. On the other hand, the government systems, the tax authorities, they do not care whether you have an easy time processing those invoices as a buyer. And so likely a lot of those invoices will be missing. And this is one of the, by far the most cumbersome change management projects that we see with all of our customers, is working with the suppliers to include enough information in the invoices that you can do efficient straight-through processing. And so we call this the data gap. And looking at the data gap, as I said before, the clearance regimes will mandate a certain amount of data. This data will be what is required to determine the taxes, so monetary amounts, tax codes, company IDs, who's the supplier, who's the buyer, where are they located, shipped from, shipped to, so forth. You will need a vendor code on the invoices. So you'll need to be able to identify who is the supplier in your systems. You need that mapping. And you need enough information to determine, is this information okay to pay? And typically that is done either to straight-through processing by having a PO number, a material code, a transport order number, or PO line numbers, cost center references, person references, etc. If you do not have this, you will need to touch every invoice, including those that today get processed automatically. And so your AP efficiency will break. Our solution to this is what we'll reveal just after this poll. I was almost
back. That's great. Thank you so much, Rolf, for coming up on your screen now. If you could tell us a little bit about how do you plan to solve the data gap between cleared invoices and the data you need to process them? Please just select one of the 4 options available in the list. We don't yet have a plan. We are looking at solution providers right now. We have an internal solution for this, or we don't have an issue with this today. If you could let us know your response, please, to how do you plan to solve the data gap between cleared invoices and the data that you'll need to process them? What's your strategy there? We don't have a plan. We're looking at solution providers right now. We have an internal solution for this, or we don't think we have an issue with this right now. So closing the poll in 3, 2, 1. Let's have a look at the results coming up on your screen now. The majority of you don't have a plan yet. 24% of you are looking for help with this right now. 22% don't believe it's an issue right now. And 16% of you say that you have an internal solution for this. So back to you, please, Rolf.
Thank you. All right. Let me see if I can deliver on the cliffhanger. We have a solution. So you can all, relax, heart rates, blood pressure can go down. We will enable what we call bridging the data gap, or enabling the invoice enrichment. The key to this is, of course, involving the supplier and providing a method for this enrichment to happen. We've looked at the following flow in a few times here, and I'll just take you through it briefly again, just to see that that we also are on the same page about it. So basically, and this is an abstraction, the general blueprint for a solution in any clearance country, and actually in any post-audit country too. The cleared invoice, the invoices come in on the buyer side of the equation. The first time an invoice comes in from a buyer, from a supplier, the buyer maps who is the supplier. The second step, and this then happens for every invoice that fails the content requirements, the business firewall rules that you set up, is that we contact the seller and say, dear Mr. Seller, we've received an invoice on behalf of your customer. In order for you to get paid, you need to add this information. And by the way, here are instructions for you to do that automatically going forward, so you also don't need to do this as a manual process. And so we involve the seller does the lifting on each individual invoice, or amends their system to output it in the first place, and you don't need to touch it, and you can get your the remainder of your accounts payable process, so your matching, your approvals, your coding, and so forth can happen. And I believe that this can also be, this whole change to clearance systems can really be used as a way to get a lot more straight-through processing and automation. Taking a few peeks at some screenshots here, we can see the seller experience. How does this look? So on the right-hand side, what we call the seller home app that we will expose when they have sent documents in, so they can see how many documents they have sent, what their outstanding amounts that they are missing out on, and they are able to action that. And so they'll be launched into our task manager experience. And from there, as we look at the enrichment experience, they can navigate from the task manager into our seller-facing Scan.io solution. The fields that they are required to fill out are highlighted. They can add the information, submit the invoice, and everything is good to go. Talking about clearance in general, to buyers, we offer expertise in all these different countries that we've covered today and many others. We follow pace with development, and we make sure that you have the solutions necessary to bridge the data gap and to remain compliant. For sellers, we make sure that they can get their invoice processed, and we also provide them with the means of outbound clearance. Why is Tradeshift relevant, and why do we think that we have a place in this world? Well, if we look at our pedigree, our founders first were part of creating Easy Trade, Nemhandle in Denmark, the first large-scale peer-to-peer infrastructure, and then they went on to help design Peppol, which now, of course, is active all over the world. We have a platform that supports these changing clearance requirements, and we have a promise that we have both the proven process, the competency that allows us to deliver the solution that allows you to bridge this both the data gap and the evolving clearance models with confidence. And so with that, really our approach is that supporting this new compliance regulation is business as usual, and our commitment is that we will help you be able to continue just doing business as usual. One of the ways that we really also differentiate is that we actually were one of the very first Western companies to support the Chinese Fapiao invoices in the golden tax system, and which we've done since 2018, and we have a fully compliant and available solution in China in use by existing customers. We have a truly global footprint, and we support clearance needs in several countries, including India, Chile, China, Colombia, Costa Rica, Ecuador, Italy, Mexico, Peru, Turkey, and now, of course, upcoming Romania, Malaysia, France, Poland, and more countries as they are announced. Very quickly, Tradeshift itself, we're a business network. We have more than 3 million connections enabled between companies, 240 enterprise buyers. We have facilitated more than $1.7 trillion of trade on the Tradeshift platform and onboarded over 1 million suppliers. You can see very well-known logos, of course, on the right, many of these today using our compliance solutions. Finally, of course, we have a significant partnership with HSBC, and so today we are in the process of establishing, and this has been well reported in the news, a joint venture company that will bring faster payments to suppliers across the world. And Barry O'Byrne, has the CEO for the Global Commercial Banking, has the following to say about it. So enabling and growing global trade has been in HSBC's DNA for almost 160 years. We are very excited to partner with Tradeshift to help businesses and their suppliers trade more smoothly using world-class technology. We couldn't agree more, and we are equally excited to be partnered with HSBC, and we very much look forward to unlocking the growth potential for our customers by bringing them faster payments, and so both getting paid faster and being able to optimize the cash flows for everyone. So that's it.
Great. Thank you so much, Rolf. So we'll move through to questions. I think it might be worth adding, if you're available on this coming Monday, we have a deeper dive into two of the countries that are highlighted here. So we're going to be spending 90 minutes in a virtual masterclass looking specifically at France. I know a lot of you ticked France as a significant country for you, and also Romania. So we're going to be diving into those countries in more detail and taking a little bit more time on those countries. Would you like to join us? We've got a few spots left, so yes, sign me up, or maybe send me more information. I'll leave that open for a little bit, and let's jump into questions. So let's have a look. We've got a question here, Rolf, which is, in case of a clearance model, should both of the invoice issuer, i.e. the seller, and invoice receiver, i.e. the buyer, need to register the clearance system and use for each sales/purchase transaction?
Yeah, so it varies a little bit by jurisdiction, so by country, where the obligations lie. And for instance, in Romania, it's actually an obligation on the supplier to clear the invoice, and there's not an obligation on the buyer to validate as such. Most buyers, I think, will want to validate that the invoices have been cleared. And in countries like India and like Malaysia, where the supplier has an obligation to transmit directly to the buyer the invoice, there will be, and we see this as a pattern in many countries, there will be a QR code with a validation link where you can connect to government systems to validate that this is in fact the right invoice, and this is a service that we also provide in many of these countries. So the short answer is it depends on the country, but generally the sellers must clear the invoices, and in some countries the buyers also must validate the cleared invoice content.
Okay, great. Thank you for that. And I've got many more questions, but I'm also just going to use this opportunity just to launch our final poll question, which is, would you like to have a demo of the Tradeshift solution? So I'll leave that one open for you. Yes, or maybe later. So let's keep going. We've got more questions coming in. So how is the concept of clearance applied in the different countries? On which data elements is clearance given, and what proof is available for the seller buyer? That's a nice big question for you there, Rolf.
Yeah, there are quite a few elements in that. So I think generally the clearance regimes or jurisdictions define formats for all these different document types. And remembering, of course, it's not only invoices. It's, we see invoices, credit notes, refund notes, corrective invoices, debit notes, self-billed invoices, and a few more, right? And so the formats for all of these are specified, including, and again, it differs jurisdiction by jurisdiction, including what is the minimum mandatory content that is in there. The proof of clearance, and again, this is a little bit back to my previous answer. So in countries like Poland, like France, like Romania, I'll stop to try and memorize, but in countries where there are inbound clearance, Malaysia has this also. The buyer has the possibility of connecting to the government systems, retrieving all the invoices directly from the government systems, at which point you don't need to do a separate validation of the content because you did receive it from the tax authority. In other countries like India, and we see this, I think, in Switzerland, and we'll see it in Malaysia also, there is going to be a QR code, including this validation link. You can then go to use that validation link to then validate that the cleared invoice. We see it, I think, also in Chile is one of the examples. Validate with the government systems that the contents of the invoice that you receive from the supplier actually is what was cleared, right? So to eliminate fraud. And in some countries, we see that that is an obligation on the buyer.
Okay, great. Thank you. So let's move on. We've got more questions, and I don't think we're going to be able to tackle them all today because we've only got about 4 more minutes, but let's keep going. What is the biggest change compared to today's EU VAT requirement on the invoice versus the German format?
I think that that is a level of detail that we are happy to engage with offline, but I can't answer it right now.
Okay, that's fine. So let's move on. So if the invoice is missing a PO, usually customers AP rejects the invoice and will not add a PO on the invoice on their own. They'll ask the vendor to get the number and add it to the invoice. How is this solved?
Yeah, so that's the crux of bridging the data gap that I was talking about, right? As the accounts payable function, you need the PO number. Without the PO number, you don't know whether this invoice is good to go. What I presented today is, I think, the heart of our solution, which is there's nothing wrong with going from a tax compliance perspective to go back to the supplier and say, which PO is this for? Add that PO to the invoice, the PO number, and then use that PO number in the downstream processing, where you then match it up against the PO and you do your two-way matching, three-way matching, your tolerances and all that. We handle this in Tradeshift, right? So the Tradeshift system will handle all this. It will communicate with the supplier, get the supplier to add the data and so forth before it hits your AP process. We can then do that AP processing for you in Tradeshift, or it can be done within your ERP system. However, that whole thing is set up. That depends, of course, buyer by buyer.
Okay, great. Thank you for that. How do you process self-bill invoices? And I think it came up earlier, but can you just kind of flesh that one out a bit more?
Yeah, so there are, I mentioned self-billed invoices in the context of Malaysia. So generally for self-billed invoices, we'll provide facilities for buyers to get self-billed invoices cleared, because of course they need to be cleared with the tax authorities, because that's where the tax determination happens. In Malaysia, and I think it's a little bit of a misnomer, but they're using the self-billed invoice format for buyers to register taxes from international invoices. So they receive an invoice from an international supplier that has taxes. The international supplier is not known by the Malaysian government tax authority, and so the buyer has to clear the invoices, and they do that by sending this self-billed invoice, which really is not a self-billed invoice. It's just registering the taxes.
Okay, great. We are going to have to leave it there because it's coming to the end of the hour. Lots of questions, so I think Tradeshift will contact you directly. Many of you are asking if you will get a version of the slides. We will share the recording, so you'll get Rolf talking you through this with obviously the slides to connected as a follow-up should you be interested in sharing that. And we also have TradeShift joining us in a couple of weeks' time, talking about using artificial intelligence within 5 sub-processes within e-invoicing. So please do join us for that one. That's live on our website. So thanks so much for your time today, and huge thanks to Rolf. And we look forward to catching up with you again soon. Thanks so much. Take care. Bye.